In today's WASDE report, the USDA came out with a number of assumptions, a number of estimates rather, for the U.S. and the world cotton market that were largely as we had expected. We saw a good bit of loosening both domestically and worldwide in old crop and new crop numbers. Of course, the market is turning more attention to newer crop numbers now, and we saw a good bit of erosion in those numbers, resulting in bigger ending stocks and a looser stocks-to-use ratio, which tends to be bearish for price. I'm a bit surprised that they took 500,000 bales off the old crop export numbers. I was expecting a little closer to 250 or 300,000 bales, but as we've seen such an erosion in the export numbers, the weekly export reports the last several weeks, that it isn't super surprising, but it was a bit more than I had expected. It certainly was a bearish report, but I think a lot of that bearishness has already been built into the market. Now, certainly they had reduced the U.S. Production number in spite of the big increase in plantings released just on the June 30th acreage number. But the decline in production, I think, has long since been factored into the market. The Texas crop has just been a train wreck this year. The worst drought in history is going to result in what's likely to be the highest abandonment, U.S. cotton abandonment in history as well. So the million bales they took off the U.S. production number, while bullish in its own right, I think was more than offset by a number of bearish indicators elsewhere. We saw a 1 million bale reduction in Chinese milk consumption, and we saw a big increase in the anticipated size of the next Australian crop. The strengths and weaknesses of the market, I think the market is leaning more to the weaker side. We have seen such a glut of both cotton and yarn inventories worldwide a couple months ago, with prices ratcheting up as rapidly as they did. But since then, as prices come back down, we've seen a number of mills worldwide, not just in Asia, but particularly in Asia, that have been really caught, I think, with this excess inventory that it's taking a good while to digest. Once that inventory is digested, the market, I think, will then come back. But for the time being, I think it's a big bear. Well, certainly the Texas drought has been a major issue. We've seen dryness really from the Carolinas through Arizona this year, an unprecedented drought in a number of states. The latest crop numbers released on the Crop Progress and Condition Report Monday afternoon showed that Texas is still just in dire straits. Oklahoma, I think Oklahoma City has seen since June 28th over 100 degrees every day since then. Not a cotton grown in Oklahoma City itself, but just symptomatic of the catastrophe going on with the Oklahoma cotton crop. Georgia conditions improved incrementally, but really there was not very many places to go but up, as the crop was in such dire shape. Looking at the macroeconomic picture, I think that also will weigh to the downside, both from the issues going on in Europe and also the debt issues we see going on in the U.S. While not directly an impact on the cotton market per se, I think it's likely to have more of an overhanging impact on the cotton market. If we see longer-term strength return to the dollar, of course, a stronger dollar is likely to weigh on the commodity space in general, and certainly on cotton, which could serve to pull cotton prices a bit lower than where they are now. With oil prices likely to stay relatively high going forward, I think that's going to help to boost or help support synthetic fiber prices long term, which really puts mills manufacturers in a bit of a pickle. That if cotton prices, while lower than they were a couple months ago, are still prohibitively high, and synthetic fiber prices are also prohibitively high, where do you turn? You're kind of caught between the two issues. Adding a third complication to this, when you look further down the supply chain at retail, you've got consumers that, particularly in the U.S., have been accustomed to expect lower apparel prices. Consistently, year over year, apparel prices lower at the store shelf. But now you're seeing, with the spike in cotton prices over the last 2 years, as those higher cotton prices work their way through the supply chain, eventually it's going to get passed on to the unsuspecting consumer, with a consumer who's expects, one could argue even conditioned to expect lower prices at the store shelf, suddenly sees higher prices for her jeans, for any type of cotton dominant apparel. I think it's going to be an uncomfortable situation for retailers. You've got consumers that are expecting lower prices, but mills, manufacturers, brands, retailers that are having to pass along higher prices for apparel, and it promises to be, I think, a painful situation.